Hey guys, just wanted to make a video real quick. I haven't posted on YouTube for a while, so I just wanted to make a video and kind of show you where we're at, what's going on. Um, it should be a pretty quick video. I just want to go over how I use ICT time macros to engage the market and get really good entries and get really good price action movement. This is something that ICT has taught a lot on his YouTube channel. I just want to kind of go over two macros that I use very, very often to get really nice price runs. So, first one is 950 to 1010, which is this macro right here, and then the next one we're going to go over is the 1050 to 1110 macro, and this is where I spent most of my time. This is where I traded I guess on this 30-second time frame. These other entries, these were on 5-second charts, just kind of getting myself into the groove of some things. I missed this trade right here. I would have went long on this candle here where it took out sell side liquidity. But we'll go over these two macros real quick and kind of give you something to think about. So 950 to 1010 macro, which is this macro here, this is a time in the day where price will give signatures that it wants to do something, that it wants to either continue or reverse. In this case, I've been bullish today, and so I was looking for an opportunity to buy. And the opportunity that it gave me is I have another chart here, which is ES. So this is the S&P 500, and we're trading the NASDAQ futures. So this was the signal that it gave me that I wanted to go long. See how that created a divergence, SMT divergence. ICT teaches this as real accumulation in the markets. And what I would have done is I would have entered on this candle. As soon as this candle opened, I would have opened a trade, and then I would have pyramided another trade in this fair value gap, and then I would have traded to the top of this orange level, which is a 15-minute fair value gap. And that would have been the trade for the 950 to 1010 macro. Now, if you scrub over to the next one, which is 1050 to 1110, as you can see, price really kind of just plays around on both sides of this 15-minute orange gap that I have. It's clear over on the other side, but it just plays with both sides of the market. And I've been bullish, like I said, so in order for me to get ready for this macro, I went down to a 5-second chart and just practiced some entry drills. That way I knew when I got to this time that I would be ready, I would be fired up, I'd be warmed up, I'd be ready to go. So the characteristics of the 1050 macro that ICT teaches is it's usually a stop run, meaning that it's kind of like a ditch. As you can see here, it kind of creates this ditch effect where it comes down, it takes out this low right here, it takes out this low right here, and it soaks up all of those sell stops. So everybody who's been long in here, they're now taken out of the market, which makes room for smart money buyers to then accumulate long positions below this level and then to rally higher. As you can see during the macros, it really starts to run right before it accumulates, and then it starts to spool, meaning it starts to go higher or lower. It starts to expand in one direction. Same thing with this macro. What I saw during the 1050 macro is, we'll go over this is the actual trade that I took for the day, is we have a order block right here. And I didn't want to see it go below that order block, but I did want to see it take out this low right here, and then take out this low right here potentially. If it didn't take out this low and it only took out that low, I'd be okay with that and I would have entered. But what I saw is it came down, took out that level right there, boom, just barely, and then my entry was right here, right on that blue line, right on that blue arrow. So it traded down. I waited for it to trade down into this candle right here, which I was treating as an order block, and I waited for it to trade down. My stop loss was below this order block. It shouldn't go below this order block. And my ultimate target was this level right here, which is 15-minute highs. That was my target for the morning session. And as you can see here, I wanted to pay myself quite often and frequently. And so we had a small buy side liquidity pool here. I waited till it got up into that, took a partial there, took a partial there, and then once it cleared this breaker, this is something that ICT teaches and happens quite often in this macro. Anytime you have a buy side liquidity pool and then a sell side liquidity pool taken, that candle is going to be a breaker. So if you want to learn more about that, find it on ICT's YouTube channel in his core content. But this is a support area, this breaker. So once it came down, once it broke through it, I took another partial, and then it came back down, touched it. If I was actually trading my full model, not just my scalping model, I would have actually added another order or two right here when it tapped that, and then I would have held for this buy side liquidity pool here, and then this is a minor buy side liquidity pool. So it comes up, I took my last sell right there, right on that line, and then the market has begun to spool in its second stage. And since then I haven't traded, but I just wanted to go over those two macros with you to kind of show you that these are things that repeat every single day. I really like this one. I call it the ditch. It's the last ditch. It's the last run of liquidity for the morning session before it usually accumulates or consolidates during the lunchtime. So really good times to trade: 9:50 to 10:10, 10:50 to 11:10. Just like ICT taught me. Alrighty, that is the video, and I hope you enjoyed it. Hope you found it insightful. Have a great day, and we'll see you later.